Some traders buy and sell major index ETFs to make money, but that's a problem. Such ETFs are long-term investments and it is difficult to predict the index performance as a whole, especially when it becomes a guessing game of something that is far into the future. Have you ever wondered what could be a better way to trade the index and potentially make a handsome gain out of it? Before I get into that, it's important to share a little bit background of the stock market so that you can start trading like a boss later. So, when the Fed started to increase interest rate aggressively since 2022, investors know that companies with high borrowings will suffer from high interest rate expenses. As a result of that, profits may fall and that will have negative implications on stock prices. The Fed had increased the interest rate from near zero to more than 5% today. But where the market is right now, it's more bullish than ever. The S&P 500 is up by 18% since the Fed started its interest rate hike campaign. Dow Jones up by 12% and the Nasdaq has gone up by about 28%. You see, the US has already gotten used to low interest rates since the 2008 subprime mortgage crisis. The Fed at the time chose to lower the interest rate to near zero to keep the economy afloat. The idea here is that if everyone is able to borrow money cheaply, they will use the money to spend, to invest, and keep the economy running. For the economic nerds out there, let me run by some numbers here. According to research done by Statista, the total US consumer debt, which measures the amount owed by an ordinary person on the street, stands at a staggering $17.3 trillion as at the third quarter of 2023. For context, Malaysia GDP, which is a measure of the productivity of all Malaysians combined, was estimated at roughly over $300 billion. What I'm trying to say is that the amount that US consumers have borrowed up to September last year was 5 times more than what Malaysian can produce in a year. That's a lot of debt we are talking about. Fast forward to 2022, 14 years after the subprime mortgage crisis, the Fed finally realized that they shouldn't keep interest rates low for too long before their debt issue becomes a national crisis. But you see, when interest rates suddenly jump from near zero to over 5% in a span of just 2 years, many people and businesses are not able to earn fast enough to cope with the high interest rate amount on their borrowings. One way to cope with this is to cut down their consumption and investment. That means cut down on spending lah. Spending to you and me and businesses is actually profit to the companies. When spending is lower, corporate earnings will also be lower, and that in turn may cause the stock market to weaken. What happened in 2024 so far is mind-boggling. On one hand, everyone is expecting the stock market to crash. On the other hand, the US economy continues to grow much better than expected, and we are in one of the best bull runs in history. Did the majority of investors see this coming? Probably not. The truth is that it just gets harder to predict where the market direction is from now on. That is because the stock market today is not as straightforward as it seems. Take S&P 500 index for example. The index is supposed to track the share price performance of the 500 most valuable companies in the US as a whole. But since AI is the big thing and investors are all hyped up about companies that venture into AI, all the money is going there. As a result, what we see today is that 7 tech companies that are growing in size in terms of market cap and eventually becoming so huge that they control the fate of the S&P 500. If one of these 7 companies get into trouble, like what happened to Apple recently where it got fined by the EU worth $2 billion, it may drag the whole index down. On top of that, nobody knows how long this AI frenzy will last. And when it ends, it may change the dynamics of the S&P 500. Maybe the 7 companies won't matter anymore, which means whatever you know about the behavior of the S&P 500 today is going to be irrelevant in the future. There's a better way to trade the index, and that is to look at the futures market. Unlike stocks or ETFs where you are buying an ownership of a securities, the futures contract is a contract that is legally binding agreement to buy or sell a standardized asset or securities on a specific date. Because of this unique feature of a futures contract using the S&P 500 as an example again, the goal here is not to analyze all the component stocks in the index and hold it for the long term, but simply to form a view of what may be the trend of the index in the next 3, 6 or 9 months. I think that's more manageable than trying to forecast how all 500 companies in the S&P 500 will perform in the next 3 to 5 years. All you need to do is to compare the price quotes of CME Group's E-mini or Micro E-mini S&P 500 futures contract that expires in the next 3 months or the next 6 months. That would give you a rough gauge of how the market thinks it is heading to. Things like the potential interest rate cut in the US and the upcoming US election by the end of the year. Keeping up with so many things happening around the market is just time-consuming and draining sometimes. Secondly, if you foresee a market downtrend in the next couple of months, there's this feature on the futures market where you could short the index. It is one of the greatest inventions for traders where they could take position of both sides of the market. How it works is that you lock in the price of the futures to sell at the current price, and when the index falls in the future, you could buy back the futures at a lower price. Thirdly, and this is building on the point that we can short a futures contract, is that many investors would use it to build a hedging strategy to protect their portfolio. Say you are very confident that Nvidia will continue to give you that 10 times gain, but at the same time, with what's going on with the economy as a whole, you feel really uncomfortable with the market keep going up. You probably get the point now. You buy Nvidia for the long-term bullishness on the company, and you short the S&P 500 index futures to protect yourself in the event that the market did crash. Be mindful that hedging your investment does not guarantee return. If Nvidia starts to fall but the US economy remains strong and push the S&P 500 higher, you will amplify your losses on those positions. That sounds scary, right? For beginners, you probably feel that futures are too complicated to understand, but there's one open secret of why you should at least take a look at the futures market. Many traders look at it simply to make sense of the current market sentiment. Since futures trading is all about buying and selling an asset at a specific date in the future, the fact that the S&P 500 futures is trading higher than the spot price listed on the stock market today means that traders are confident that the market is still bullish in the near future. That will help you to decide whether you want to continue investing or to stay away from the market. To get access to the futures market, you can click on the link in the description below to sign up for an RHB Futures account. For new users, RHB is offering free brokerage of up to 500 ringgit on your buy contracts for 60 calendar days. This offer will last until 31st of August, so don't miss it. Oh, you may also stand a chance to win a Perodua Ativa SUV or amazing vouchers worth more than 200,000 ringgit. Check out the link to find out more details and terms and conditions of the campaign. Okay, I hope this video helps you to be a more confident investor, linking up the actions on the stock market together with what's going on with the similar assets listed on the futures market. Number 1, futures contracts have expiry dates, giving you a snapshot of what the market thinks an asset price trend may look like during that period of time. Number 2, you can short a futures contract to hedge your positions on your existing stock portfolio. And lastly, observing future price quotes to assess market sentiment can help you to derive a valuable strategy to profit from the market. If you like me talking more about futures, click on the like button to let me know. This video is also available on Spotify, so don't forget to check that out, and thank you for watching.